Okay, folks, welcome to what do we got? FOMC 27th of July. It's just gone about 6:45 here in Dublin. Hope everyone's doing well. So what we're looking at essentially here is a 75 basis point rate hike from Jerome and the boys and girls at the Fed. Now, just to let a couple of people filter through, just going to give it a second here before I can go ahead with a little brief look ahead, but not too much complication about this one. Flip it over to the charts for a couple of minutes there. Okay, so we've gone just 6:47. Couple of minutes now until we get the interest rate decision from the FOMC. Yeah, 12 minutes now until the top of the hour. So we're going to be handing over to the guys in News Squawk for this to read out the statement. Read out the rate decision live. And so let's have a little recap now. 12 minutes to go on what's been going on today. So first of all, let's look at the VIX. Okay, so look on the VIX. Generally, getting out to the VIX on like a daily. Let's look at max monthly bars here on the VIX. Right now, a lot of people are going to be thinking, "What the hell is the VIX?" And so, if you're interested in what the VIX is and why it's important, do join us in Duggan Capital. But this is one of the most important tools you need to be looking at when you're managing risk and considering equities positions. Now, what I want to draw your attention to is this general sort of uptrend channel we have here on these monthly bars since kind of holding the bottom at 1648. I actually remember talking about 1648 used to be a bit of a kind of common ceiling in the VIX in and around 2018 and 19, but now acting as a floor. Talking about that really back in June 21. However, we've sprang from there, and this channel is holding, right. So we've had this channel, just kind of let people know where we're at. We had this channel. Here we are in the 15-minute bars. We've seen the VIX. It can't hold this 2565 area. We were looking at that yesterday. Pushed above, of course. Tried to hold, couldn't. Overnight session comes down, stays down. This is a target for the VIX now. So as the VIX continues to drop, we will see equities continue to rise. Okay, so that's pretty much basically the VIX is the fear index. People buying more downside protection will make this thing go up. People getting out of that, it will go down. All right, here is the squawk.
Is expected to hike rates by 75 basis points, which should take the target range for the funds rate to 2.25 to 2.5%, which is a level considered neutral. There's no summary of economic projections at this meeting, therefore attention will turn to any guidance the FOMC provides us on future tightening increments. Current expectations, based on the current outlook at least, are for a 50 basis point move for September, before moving to 25 basis points in November and December. See the year-end rate of 3.25 to 3.5%, which is in line with current market pricing. Nonetheless, the Fed will likely reiterate that any future rate decisions will depend upon their assessment of the economic outlook, particularly inflation. The latest June CPI report we saw was hotter than expected, which did initially see markets pricing another 75 basis move in July before accelerating to start pricing in over a 70% probability of a 100 basis point move instead. Although since then, pricing has now pared back in wake of several Fed speakers, including the hawks such as Bullard and Waller, who did offer their vocal support for a 75 basis point hike at this meeting. Meanwhile, we also saw the latest University of Michigan consumer inflation expectations also called for both the 1-year and 5-year horizons. Currently now, markets only see about a 13% chance of a 100 basis point move, as opposed to above the 70% at the peak. And it's just worth noting as well, after the last meeting where we did see a George dissent for a 50 basis point move, we'll be on the lookout for any more dissenters this time round, but it is worth highlighting she did dissent to the 75 basis points hike in June as it went against the Fed's communication leading into the blackout periods.
Okay, so that was a pretty decent rundown from the squawkers. So let's just look at where we sit on equities, right? So I'm gonna drop the VIX, but do not discount that move that we're looking at on the VIX. Very important, and we have indeed seen. We were looking at the longs on equities. Quite a few of us in the Duggan Capital room getting on this trade, in and around the open. Sure enough, bam, up we go. Opening drive. Well, was it an opening drive? It wasn't really. It was a bit slow and steady, to be honest. Nonetheless, reaching into highs there on the 2 days on the SPOs. So, to look at that on the daily bars, really, we've been talking about it till we're blue in the face. Target 100 EMA ever since we actually, it was kind of last Thursday, we were looking at, buyers stepping in from the lows on last Thursday to target up at the 100 EMA. We have our other reasons to be getting long are in and around what were the lows of yesterday. Swinging from the lows of last Thursday, Holy had to get out of them and look on the short side yesterday. Then, coming the open today, we were on the longs and still on the long. Also looking at gold actually as a nice asset at the moment, but that's the long and short of it. We're looking at, staying long 100 EMA by and large, right? 75 basis rate hike. It's priced in. We're going to get to this event, 75 basis points hike, bam. Who cares? All right. 1%, a whole percentage point hike, probably not priced in. We could probably come back a little bit from the highs that we've seen. Nasdaq up 2.6 on the back of good tech earnings last night, post market from Google, Microsoft. Look, we're up 1.3 on the SPOs. Could we do a wee bit of a pullback? Sure. Sure. Unless Jerome comes out and well, to be honest, let's just kind of get a couple of things straight here. They've said the Fed said that they need to see about 2 to 3 consecutive downward prints on the CPIs or PPIs or PCEs for them to ease off the inflation or the interest rate hiking. All right. We haven't even seen one downward print really worth talking about. Okay. In terms, I think we've seen it on a little bit on CPIs about a month ago, but that's not, it wasn't really what they were looking for. So we haven't seen the PCEs, we haven't seen the PPIs coming off. So therefore, they're nowhere near stopping. I mean, okay, come the end of the year, probably. All right. But again, just when you think inflation is done, it's not. So is the 75 basis point hiked in for this meeting? Yes. Is it hiked? Is it priced in for the next meeting? Probably. Yeah, probably is. All right. So, I think the dip is being bought in a larger sense. For me to abandon that concept, we're going to have to breach. We're going to have to breach these lows. These lows of like the 20 EMA. We're going to have to breach there. So I think a pullback down onto these levels is going to be a pretty heavy headline risk. It's probably going to be a 1% hike, and it's probably going to be a narrative from the Fed to say that they are kind of losing a little bit of control of the situation and they need to adjust to bigger rate hikes. All right, so that's essentially it. On the back of this, we've seen a super, super strong Dixie, the dollar index, of course. Talking earlier a little bit about this, I think the yield on the bonds is actually kind of got an inverse correlation to the Dixie. So essentially you got a positive correlation with the bonds, right? So Dixie to the bonds. Can we go higher in the dollar? Absolutely. I think we can go higher in the dollar and we can go higher on equities. How does that make sense? I don't know. But since 2020, I've seen a lot of things that don't make sense. So you cannot be really looking to buy much of a dip on the euro. It's broken a pretty decent area where buyers were trying to step in at one spot 0.1725s. It's just not there. So remaining long the euro USD, I think, is the order of the day so far, until we start to see outsized hikes come in from the ECB. Oil, I'm not going to talk about nat gas at the moment. Not over this. Oil doesn't really care about FOMC either. But just, as this dollar weakens off now, you may see oil, which has had a really decent run of it so far today. A lot of us were on this trade here. Parwiz, unfortunately, bemoaning how he wasn't on this trade. We were buying a nice little dip here. Very tight risk, buying a nice little dip here. Got out at the 97.20s, was it? It was the high of this candle here. 20 ticks of risk. Bish bosh, 12, almost 13 to 1 on that trade. Lovely. And it's still going. I'm certainly not still in there. But lovely trade on oil. So as the dollar weakens off, we may see oil appreciate a little bit more on this session above the 20 EMA. All right, we got just coming up on 2 minutes left. So about this time, I'd just like to check in with everyone. How are we doing? Should be live on YouTube. I think we are. So watching on YouTube, hope you're doing well. Just coming under a minute now. Walk is live. I think generally, no matter what we get, I think it's just a little bit of pullback, probably to the 50 EMA for SPOOs. 1 basis point hike could go back on pivot. There is actually a wee gap here to close. But anyway, coming on 30 seconds. Just noted this gap now. Same on NASDAQ. I don't see it being that bad on NASDAQ.
10 seconds. That's hiked 75 basis points as expected to 2.25 to 2.5%. Fed says that's the The recent indicators of spending and production have softened. Job gains have been robust and unemployment rates has remained low. Says inflation remains elevated, reflecting pandemic-related imbalances and higher food and energy prices and broader price pressures. Balance sheet reduction will accelerate in September as planned, with monthly caps off runoff rising to 35 billion for MBS and 60 billion for treasuries, as initially planned. Is prepared to adjust policy as appropriate. Votes in favour of policy was unanimous. So again, they do maintain that language. They are strongly committed to returning inflation to 2% goal, and that they are prepared to adjust policy as appropriate.
Okay, so sort of like, sorry, hold on. I'll just leave the squawk on until he gets through the full statement here for anything more.
So again, just to recap that there, it's very much as expected, hiking by 75 basis points. Not too much changes to the language, though. It was a bit of a downgrade on the initial paragraph regarding the strength of the economy.
Okay, just on the SPOOs there, just a bit of a rewind into CVAH 3977 quarter for the team. Actually, large offers taken out just there. Sorry, just trying to get the actual. Yeah, 3975s, about 500 lifted on the offer there. So pretty nice action, but not much follow through here. So sellers getting absorbed at these levels. So we got a bit of a country mile now in market terms between now and Jerome speaking in 28 minutes. So I do like the technical action on the ladder here. Offers getting absorbed, lifting. Offers being lifted here. There you go again. 70 lots lifted in 81's half. Looking at the highs on day on SPOO. So nice opportunity to get in on a little bit of a pullback there on the SPOOs for continuation to the upside. Nasdaq on the highs of the day. Dow limping behind, stuck in the range, waiting for probably Jerome to say something. But I think I think the dip actually there at about 5:30 was quite nice on the Dow. Don't like it too much compared to the SPOOs though. If we move over to the daily that we've been looking at in the team earlier on today, you see what we're looking at here. So really looking at upside T1s here, 40-60 quarter, 40-60 spot 25s, and here we go running. So bear in mind we're up 1.5. You'll see just in the background, I'm looking at a couple of these markets. Amazon holding up 3.7%. Cathy Wood's ARK fund up 4.6%. Google up just shy of 7% there. Was actually up about 5% on the pre-market. Facebook holding 6% up. Microsoft, their earnings are going to come after the bell tonight. Microsoft 5.2 up. Netflix up 4%. I mean, this is why I was tweeting out that have we bought the dip? Have we bought the dip? Nasdaq now moving on 3% and more in the highs here. SPOO's up 1.6, new highs. Lovely action. Dollar getting a little bit weak there. Get a bit of a smackdown onto pivot. It's traded on that fib level, 107.44s. That's a fib extension. Yeah, I mean. It has. Yeah, it's been an interesting area to trade on the Dixie, this 107.44. So let's see if we can break pivot. I don't know if we can in the dollar, to be honest. A little bit of pullback on the bonds. You can keynotes, you can see, and gold maintaining near the highs on day, just below R1. Oil taking advantage of that weaker dollar, holding on the highs. CA, how you doing? You doing well? Reed, what's up? A little bit of a smackdown there. R2 on Spoos. Saw the Dow go back on high of day and then rewind. So let's have a look at the VIX where she sits right now. Yeah, so a little bit of excess in the lows currently on the VIX, but I'm telling you, it needs to get down 24.38 before you should probably be a little bit scared about what may come in there in terms of buying on the VIX, which would then give a smackdown on equities. So yeah, Ollie, you're right. Ollie's saying looking at the markets, forgive him for thinking nothing actually happened there. And well, yeah, priced in as we were talking about. Now, a bit of a rewind. So we've blown top after that information. Back to VWAP on Spoos. So it was both third. Yeah, yeah. So two of the traders looking at the full basis point hike. No such luck, lads. Looking over at crude. I mean, look, we're on the highs of day here. There's potential for a nice long on crude. On the pit chart, got VAH with PVAH with pit +1 there, and around 97.40. Yeah, and you've seen that long tail here on the VIX, top right of your screens. You know, it's reversal back onto 121s, 120 spot or 120.10. Gold still holding up quite well. So this gold has been a nice little area. If we pull this up while we're live here, you know, the trade we've been looking at in the room has been long this general touch on the bull flag trend here. So got this trend by drawing these two tops, now duplicating that line down to start from here. So at the week of the 1st of June 2020, right? And we have this general then bull flag, massive bull flag. These are weekly bars. So generally for the swing, I like gold from down here, and campaigning to buy on these lows today as well on gold. So we switch to the 60-minute. You can see just here, automatic help. fix for now. See here. Generally, a lot of these pushes down into this area. As it's kind of been a CVAH for multiple days, and you can see excess on all the touches being bought back up. So I think for gold, this is a 200 weekly exponential moving average. So to look at it on a daily perspective, daily moving averages are further away. But either which way, I think gold. Fix this. Yeah, so they're in gold. I like the longs basically. I like the longs. Buyers coming in to support on VWAP on SPOOs. Oil about 20 ticks off the highs. So anyone doing any trades? No. Baggers, how's it going, man? Good. So we're in a bit of a lull period here for about 18 minutes. So I'll let you guys talk yourselves for now. Before I do that, though, really, well, let's see. Let's see. Probably at in about 7 minutes time, we'll come on and we'll look at where these markets are at. But really, something I'm looking at is going to be what are T notes and the dollar going to do once Jerome starts talking, and that's it. I mean, generally, it's quite unsurprising that equities are not really interested in taking the short side pull back here at all. Still supported over VWAP. So yeah, 7 minutes. Ollie asking, am I in any position on bonds? Do I have a bias? I am not in a bond position. Bonds, like, prop. See how it's looking. No, I don't think I want to do any business with the bond up here. No, it's a bit too high. If it comes to my head, I'd have to actually be short this bond for the remainder of this session. And saying that, I just don't like that trade. I just don't like touching it where it is here at all. So, no, not in a bond position. Would I recommend a bond position? And not without hearing Jerome finish answering his last question. Here we are in T notes on the weekly. I mean, yeah, we were kind of looking at a general theory. Well, actually, more on the bond here on the bond daily. or sorry, weekly. Having a bit of fun buying and selling this a couple of weeks ago. Over the last 3 weeks. But the short side definitely seems to be the losing side right now. So yeah, I'd rather be taking a bond trade in the morning, to be honest, or any bond trades in the European Open. I mean, this level on T-notes, now while we're here, this level on T-notes is the high from this sort of abandoned high up here. Yeah, 31st New Year's Eve on 2018. So 120 /10 here. So what does that mean? Not much, really. Do I want to be long short that level? Not really. It doesn't look like the best level I've ever seen. And I'm not bringing up my keynote ladder to have a look at that either. Yeah, nice trade, P-Wiz. This doesn't sound right calling you P-Wiz. Your new call sign. The 100 lots on the SPOOs. What price? Looks like an iceberg, is it? Is it trading? No, it's not trading. Trading on an 80s. No, he's not there at the moment. Was it on the bid or the offer? Oh, it's moved up. Was it on the offer? Might have been. See a couple of 50 lot chunks taken out of the offer at 79s. No, they haven't traded. Sure, Ollie, you should be able to answer that question with your setup. Offer, yeah. There was an 80 lot traded there. And then a 55. And then another 55 below at 79. So yeah, there has been a couple of lumpy, actually. Yeah, it's been like 200 at 81 quarters, 190 at 80.75. $55 stepping across the spread to lift the offer at 80s there. Well, that was about 6 minutes ago. Oil, is oil flirting at you, Ollie? Oh yeah. Oh, I know what you mean there. Dollar is pressuring back on pivot. Ooh. No, I'm not gonna do that. I might though. Watching the tape there a bit, watching the ladder. breaking down. Then back up. 2740 is the area. Could easily just pip on the +1 here. ETH +1, 9714. Yeah. There you go.
Rather as expected. Did see that slight downgrades to some of the economic language in that first paragraph, but nonetheless, all other guidance in that was left unchanged. Of course, we do want to see if it will give any signal to or give any clues on the increments of the hikes the Fed will be conducting in September and throughout year ends. Currently, money markets are fully pricing in a 50 basis point move for September with about a 65% chance, but also pricing in a 75 basis point chance with about 36% probability. And of course, thereafter as well, we'll be on the lookout for any potential commentary about next year's rate hikes. If he does mention this, that is, money markets are currently pricing in rates to start easing from early next year. We'll see if Powell does touch on that at all. And of course, we have posted a link to the press conference on the headline feed. If you don't want to tune in yourselves, we'll be covering the main ones on this walk.
Yeah, oil breakdown there.
And just before Fed Chair Powell press conference, just so you're aware, as the Fed did release their statement, CBO did release an update. CBO does project US CPI to return to 2.3% historical average in 2024 and stay at that level through 2052. Just some forecasts here from the CBO.
Yeah, you just had a little pullback to oil there. You had a CVAH we were looking at earlier, 97 even, I think it was. Yeah, 97 even. So it's just below the +1. Certainly getting a little bit of a lift from there. So but the fall down was, the failure of that value high 9740s was pretty quick, to be honest. Oh yeah. Okay, so just to have a little quick look here now around these markets, technically where we lie and what good could become. So just got 6 minutes now until the presser. So look, you've got Nasdaq's been up by 3% there, a little over, blowing top on the high. A little pullback on VWAP, even a check on R1 is all possible before then, I think, moving further to the upside. SPOOs really have to hold this R1. The 50 EMA, obviously quite important today for the full session. So a pullback there, even a breach there. I think a breach on the 50, well, basically a breach on VWAP is going to be, I think we're going to pull down and close the gap here at 39.24 is half on SPOOs. You could actually get a pullback on Nasdaq to close this gap, but I would not, because the 20s there, I would not look at that as wholesale negative for the market. I mean, yes, it would be probably negative 3% on the day. I'm not looking at the shorts on Nasdaq though. Well, I'm not touching it, but I mean, that would be, negative, what? Yeah, closing the gap would be negative 2.5% on the session. And then I think tomorrow it could be, chucks ahoy to the upside again. But the thesis for closing the gap is a little bit far fetched given where we sit right now. And I just don't know what Jerome is going to say. If he gives us guidance on, like, they're definitely going to go with a 75 plus rate hike in the next meeting, or a full basis point hike, or sorry, a full percentile hike. If they're saying that that's going to be on the table, well then, I don't think you want to be. I think that may pull equities to the downside for sure. So the dollar as well. Something you want to look at here is the Dixie, how it trades on the bonds, T-notes, how this trades throughout the speech. I would like to see a collapse for the longs on equities. I would like to see a collapse on T-notes, and the dollar get down to S1 on the VIX. So it's still now printing down into that excess on that statement, or on the release. So I think 24 spot in around here, 24.23 is just below our trend line. That's really where I think the support will come in, around the trend. Yeah, lovely activity. Oil putting up a fight at 97. Not touching that unless it's VWAP. Yeah, par wisdom, my experience, the pit VWAP is a very, very much a scalper's paradise on oil. Yeah, basically. The better one is the ETH. Both are actually quite similar right now. It's only a difference of about 26 in it. All right, under 2 minutes. So I'm gonna keep the VIX on in the background. I'll let you know how it's going. But if you see the SPOOs make new highs in the day, it's pretty much going to be VIX down to target here. And considering that this is a bear flag, right? This is a bear flag. We need to see the break to the downside here to depart this trend. So could this be the session? Could this be the session? On oil, the offers are pretty weak. Once you get to 97.49s, just above there, the offers are very patchy. A lot of pulling of offers up there. Here we go. Probably just a quick check of the markets.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued.
Dollar moving up.
The labor force participation rate little changed since
Bonds dropping.
Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase is in the
Very
target
strong
range is the
buy-in here
second
on the
75
SPOOs.
basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between
New highs
now
on the
and then.
SPOOs, new highs. Here we go. All the
We will
equities
continue to
moving
make
up.
our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring
Oil
demand
moving
into better
back
balance
up
with
into
supply,
positive
in
territory
order
here.
to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook.
Yeah, fourth.
And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined.
Okay, just a little check in here. So we're just a couple of points shy of 4,000 on the SPOOs. There's about 430 offered there. Just a little pullback on R2 now, and looking for a further upside.
And to set the stage for achieving maximum employment and stable prices over the longer run.
Sorry, oil also getting a lift. I said oil back into positive territory, meaning it was back above the PVAH 97.40.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, boom. Steady as she goes. SPOOs now getting into
taking our questions. Rachel Siegel from the Washington Post.
SPOOs IB up now on the day on condition.
And the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing
Gold on the
increases,
highs.
In the policy rate that we've been making. I'd say that we wouldn't hesitate to make.
Here you go. Dollar now coming off below pivot. So a little flash in the pan there when he started speaking, and then down we come below pivot. So gold loving it here. Oil having an all right time. Let's get back to the answers.
More aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance.
SPOOs 4,000
in order to bring inflation back down. That'll continue to be our overall.
And moving.
We also said that we expect ongoing rate hikes will be appropriate, and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's...
I'm just going to come off this. Dollar now into new lows. Euro back up. Oil in the background is actually availing of this cheaper dollar environment, but SPOOs, Nasdaq, Dow, all cruising into the highs as Jerome talks about. They are prepared to go aggressive at this. Blah blah blah. The market doesn't care. It's priced in at an ultra aggressive Fed. Well, ultra will be full percentage hikes, but an aggressive Fed. Market says that's fine. We've got the message. Now we're going back up.
Of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times, what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course.
Okay, just for targets on SPOOs, forget 4,000, lads. We're trading 40. Just shy of 40 14s right now. Let me show you the balance right on this. All right, this is the balance on the SPOOs right now. Okay, so just a lot of charts to look at here, but essentially what we're looking at is the point of control from back here, right? Back around here on the 9th of May. Couple of days there, but look, we're targeting 40-44s here on this point of control. I don't see this holding up trade at all. 40-44s I think we're going to get. All right, we may need to pull back to restart that auction at around 39.80s, but I don't know. I don't think so.
And we'll make our decision at that meeting based on that data.
Gene,
Hi, Jarrell. Thanks for taking our question. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman.
Two notes on the highs.
Earlier this week, the president said we are not going to be in a recession. So I have two questions off of that. Do you share the president's confidence in not being in a recession?
George,
and second,
on SPOOs,
how would or would not
I
a
take it.
recession change policy? We're contraction of the economy.
Maybe a bridge too far, George. Maybe a bridge too far. 4077s is the 100 EMA.
The committee would be willing to abide in its effort to reduce inflation.
Up in here, basically.
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also
that's another
seeing tighter
1.6%.
monetary policy, and
I
you
don't-
should
I
see
don't-
some
I
slowing.
don't know.
We actually think
I
we
don't know.
need a period
Maybe.
of growth below potential.
I'd like to see,
in order
basically, I
for
need to see how we trade on 40,
the supply side to
44s,
catch
which
up.
is like right in
We
here.
also think
first.
that there will
See
be
how much selling
more
comes in
likelihood
there.
some softening in labor market conditions. And
But
those
I'm
are-
looking
those
at
are things that we
40-44 as
expect,
target.
and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down, and as I've said on other occasions,
SPOOs seems to be topping out a little bit here.
price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market.
Okay, yeah, get ready for a bit of a pullback on the SPOOs here to at least R2 39.90s. We'll check in on the VIX.
Differences between racial and gender differences and that kind of thing were at historic minimums, where participation
see the
was
VIX
high,
here.
where inflation was low. We want to get back to that, but that's not happening.
So the VIX still not at this destination on the trend, almost, but not quite yet. Look at that push to VWAP, sells down. Got to get down on this trend and 24, 23s before we want to get out of longs on SPOOs.
The sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand.
NASDAQ buyers on NASDAQ, buyers. Here we go. New highs on equities.
There's also more slowing going on now. But if you look at the labor market, you've got growth.
So really key to point out there. Do you think the US is in a recession? To the head of the Federal Reserve Bank, answer is no. Equities, new bout of buying. Lovely action there. Right, as we've been saying, this is the most talked about recession that hasn't happened yet. All right, back to Jerome.
Hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now.
And here comes another bout of buying. Wait for it.
Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth.
Oil 26 off the high.
Transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really, created a very strong and robust set of rules that will support public trust in the institution, and again, we're just now, the system is just now up and running, and I'm proud of what we did.
-0.7% on the session.
Hi, Katarina Sarah.
NASDAQ up 4%.
I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates, And, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases, and now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully, and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary
Rebuy
policy,
Spurs +1 on the
this
pit.
might hit in 2023. The strong
Sorry,
dollar effect may hit in 2023 when the economy might be
+1?
weak.
Shit, that's
How
+2.
do you know where you are and where you think you
Okay,
need to get
may
to?
take that off. Whoa,
Just
bit
talking
more
about
buying
demand
here.
for a second. As I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but At
be
the same
convinced
time,
on
you
this
have
move would have been
labor market. So there are
820.
plenty
So,
of
that
experiences
would have been a
where
$5 hit.
GDP has been reported as weak, and the labor market is strong, and the economy has gone right through that and been fine. So that's happened many times, and it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative, and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most, also if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
How much weakness would you be willing to accept before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can.
Nice offers being taken off the spoos here. Offers being lifted. We're back on the highs of day here with the spoos.
That the labor market can adjust.
Nice little tear in on the +2 on the pit session. So 50 lashes from me because I do always kind of talk about not buying a +2, but
perhaps lower than expected.
we were underneath the +2, well under the +2 on the ETH.
The ratio of vacancies to unemployed is just out of keeping with historical experience.
Taking a little bit of that off now.
That this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path
Just go
may be narrowed to avoiding a recession. So
just going a little longer on this broadcast as the upside is still holding pretty much on these equities.
Difficult.
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now, and I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts of possible recessions, economies? Does that affect the soft landing?
Well,
Okay, we're going to leave this here.
Since the
We're going to
beginning,
leave
I
this
think
there.
That having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal.
Okay, so just a bit of a recap here on what we've seen. Obviously, 75 basis point hike as was expected. And NASDAQ on the highs, 4.17 up here. SPOOs on the highs, Dow on the highs, dollar on the lows. Gold on the highs here as well, up just shy of 1%. So just to recap the highlights here, 75 basis point hike, pretty much priced in, pretty much what we were talking about earlier on around the open, getting on those longs and SPOs. It's been a lovely trade on SPOs throughout the day, really. A lot of us getting loaded up here on on the open back here, right? Flush below VWAP, but held on the 50, and then just looked really good for the upside and getting on there. And it's now getting on, but getting on. So target up 44 is even on the SPOs. We might even see 40-60s quarter. Will we see the 100 EMA? I don't know, man. I mean, I don't know. That's not that far from here, really. It's 1.29%. We're up 2.6. Yeah, fair enough. I don't know. It's a bit too far. I like 40-44s here and 40-60s. So we tend to see these big moving averages kind of be flirted with quite a lot on events like this. So probably asking, what are these two levels I have here? Let's get over and look at the daily bars to see what these actually they're not on here. They're on the 16 minutes. So if I just rewind certain amounts here and show you what they are. Yeah, that's just a little area really that I was looking at back on the 10th of June here, just a very tight little area of trade before the market pushed off to the downside quite dramatically. Not really going to be too fussed about that area, to be honest. I'll just put a little range on there for now so we continue to monitor. But really important that we were holding just kind of quite lazily above VWAP, and then you have that question about the recession. Jerome, what's going on with the recession? Jerome says we don't see a recession yet. And we don't, it's just talked up to these Jesus, as we would say in Ireland, without it actually happening. So look, more upside. There we go. It's all clear. Come out of your caves, dip buyers, up we go. All right. So looking back on the SPOs and the NASDAQ and the Dow, SPOs on the dailies, the destination certainly seems quite foretold right now. If we go out onto a weekly bar, let's see what we can see here. Yeah, I mean, looks good really, doesn't it? For that 40-60s for a test. I remember talking about we need to trade 36-17s before I like the long. So, I missed out on a whole lot of buy-in there because of that. But getting on with the pullbacks, we saw last week and this week onto 39-15s half, up we go. Lovely trade to be had, if you're trading on the weekly bars here. All right, back to daily bars for that. We'll just minimize. But buy everything. Gold as well, as we were talking about pre the presser. lovely action here. I think just technically it's going up. I mean, I don't really see the fundamental reason for it. I do not trade fundamentals. I don't suggest you do either. From a technical aspect, and both from a cheaper dollar and a depreciating yield aspect, I do see it. So it's very much a correlation effect. All right, the yield dropping. I've said it time and time before. Gold has that inverse correlation to the bond yield on the 10 years in both the US and Germany, but obviously the US dollarized economy being the most important, dollar down, right? So cable also availing of this upside. We're up, actually it's just kind of flat in the day here by the looks of it, it's up 0.06 right now. So yeah, I mean, look, I'm really on the verge of cutting cable from these charts altogether. Bitcoin, Bitcoin, loving it, up 10% here, just shy of 10%. We open up the crypto book and have a look across these crypto assets. You'll see everything's up here. Cardano up 5.1% to the euro. Bitcoin up, this is this is Binance this is Binance or BitMEX listed Bitcoin to the dollar. It's up 7.2%. However, on the CME here, we're up 9.27%. So interesting to see the spread between those two there. So someone's making an absolute killing on that spread. Ethereum on the weekly bars here. Ethereum up 9.5% on the week. On the daily session. 9.5 on the session today, right? So lovely stuff across the crypto assets. Doge even. The Doge up 4.5%. Loving it. And Stellar up 3.5, Ripple up 4, HBAR to Bitcoin. Obviously, HBAR Bitcoin spread will be down with Bitcoin up just shy of 10%. Matic even up 10%. So all these dollarized sort of spaces here within crypto, loving it, really loving it. So awesome session here for FOMC. Hope everyone's had a good day, a good evening. Luca's riding the Spoos Bull, I take it. Carwiz riding the Spoos Bull. Oil as well. Yeah, lovely. It's just been a really nice day, actually. I mean, a couple of quiet trades on oil and Spoos. We didn't mess around with the Dow. It really wasn't to be messed with. It wasn't going anywhere. We didn't try and get clever with the euro. Just lovely, quiet, creeping trades. Technically moving the way we trade. Lovely. So listen, if you are not part of the room, please do just get onto the Duggan Capital website. You can access the room for a month for free with the code there, and it'll be in the description of this video as it's posted as a post live video on the YouTube channel. All right, what more is there to say? Really, not much. Been a good session. The recession. What recession? We need the GDP figures. So we're really talking about recession. Jerome saying he doesn't see it. Well, that's fine, but the earnings. We're not even seeing it in the earnings yet. I think it's a 2023 story. Really is. Now, the one thing that can whip us right back from these highs and what will be a general drift up to the 100 EMA on a lot of these equities will be the GDP prints. So, Jerome has said he doesn't even see the GDP prints at the moment. He doesn't have a foresight on that at the moment. But, it's teed up now for recession. What recession? Well, the one thing that will say there is a recession is that negative GDP print. So keep a watch out for that, as we will do in the Discord room. All right, let's have a look through to the session tomorrow before I leave you. And have a look here. What do we got for tomorrow? All right, bit of Eurozone data out at 10 a.m. Consumer confidence, services and industrial sentiment for the Eurozone. German CPIs, 1 o'clock. US continuing jobless. core PCE prices, and the GDP figures come tomorrow at 1:30. So we're really teed up now for a pretty interesting 1:30 session tomorrow. So, do be aware of that. And that initial job is also coming at 1:30 tomorrow. All right. This has been the Duggan Capital Broadcast. Thanks for joining in, and I'll see you in the morning. Cheers.